There was a recent gathering of top monetary minds amid global banking turmoil. Recent U.S. regional bank turbulence has left deep scars on the world's financial markets with the risk of more to come. Our chief equity strategist and economist, John Blank, here with me now with more on the subject. John, is there more of the same in the offing for markets, with investors especially alert for what could break next in the banking sector under these rate hikes?
Well, Terry, we've got a terminal Fed funds rate at basically 25 basis points more in June at the June meeting, and that probably will end up being the end of rate hiking for 2023. However, the stress will now come when the market, which is still pricing the 10-year at 3.6%, realizes 5.25% is going to stick around for a long time until the CPI comes down. Of course, PCE comes down. So the problem here is we can get new types of banking failures when the entire term structure moves up to where the Fed funds will end up.
And that's, of course, what could break next. That's the next shoe to drop if it were to.
That's correct. I mean, we have, for example, in Los Angeles, I was looking this morning, we have, rents per square foot in office space in downtown Los Angeles pre-COVID are halved. So anybody who is, wanting to renegotiate or having to get new loans will have to upgrade to a much higher interest rate. So yes, you have the lower office prices, but no, you don't get a better deal because the loans are going to be much more pricey.
You've written recently that there's a dual track arrangement to this crisis era monetary policy. What are the two tracks?
Yeah, so if you did, macroeconomics in college, you learned about interest rates raising investment and driving up the aggregate demand curve. That is typical broad monetary policy, which is reflected in the federal funds rate, and that is basically what you learned. What you didn't learn is what's called ceteris paribus, which is all things being equal. The Federal Reserve System set up in the 17 to 20 period, and then was augmented in the 30s when there was panics, and they have what's called the 13.3, Section 13.3, which basically is emergency measures. So the Fed has, in the face of the regional banking crisis, undertaken 13.3 emergency measures, which is all kinds of other things to address banking specific instability like this. So that is the dual track approach. The standard, statutory requirement of the Fed to lower interest rates will lead to them getting to where they need to be on the Fed funds rate. And at the same time, they will and have and will continue to look into the banking crisis and make sure that bank stability is not an issue for the U.S. economy.
So how do you feel about the last FOMC meeting, especially with Powell's remarks, is saying that the committee is considered a pause in the rate hikes in the days leading up to the meeting, which I think is what you alluded to a moment ago. Does this all signal that they're pivoting away from their hawkish stance and possibly a new outlook?
I don't think so. I mean, we've got to remember they have 8 meetings, and they make their decisions at those meetings, not in front of these meetings. I think the market thinks they make them in front of the meetings like 6 weeks from now, not in June. And that's not correct. The federal funds rate will be set again in June. So that's what's going to happen. And all the data up to that time will then be reflected in the Fed funds rate then.
Let's circle back to the banks for a moment. The Fed created a new liquidity facility to backstop the regional banks. Again, I thought that's what you referred to a moment ago. Have the markets priced that in along with the possible Fed tone change, if there's any? And if not, then what have they priced in at this point?
They absolutely have priced that in, Terry. The answer is they absolutely have priced it in. What they're now trying to price in is additional unseen 13.3 emergency measures, which they may see.
So with pressure on the banking sector, then, where do the cracks in the stock market lie? I mean, technicals look tough even for some of the bellwether stocks.
I don't know if I agree with that statement. The NASDAQ is up, 12 to 15% this year, which is being taken up by the mega caps, which have already fired a bunch of people to get their profits up. So in a mega cap environment where a few big companies can hold the stock market up, we're holding up pretty well. And I would just tell people that the S&P 500 for the last 9 months or so has moved from 3,800 to 4,200. And any move like we're doing today, we're talking on Thursday, March the 30th, and basically we are getting a rally moving over 4,000. That doesn't mean anything. We can move all the way to 4,200 on just a range trade. What would really make a difference here would be if we broke 4,200.
Well, the first quarter of the year so far has been rattled by the bank turmoil. Some financial market stability is much hoped for in the days going forward. Do you think, bottom line, that would become a reality?
I think 2023 might surprise everybody, and the answer would be yes. I think because of the staggered nature to commercial lending and the ability to renegotiate, that the next shoe to drop might come much, much later this time. People are trying to equate this situation with the 2008-9 situation, which was a residential housing securitization collapse. This is a staggered reaction to higher inflation from COVID. How the market has married those two scenarios in its mind to be the same is just step back and ask yourself, is that the same? And the answer is no, that is not the same.
And in the meantime, it seems to me anyway that a positive alternative for investors doesn't seem to be in bonds either, because the government bond rates dipped a bit, haven't they?
Yeah, this is true. I mean, we've got, kind of a mixed bunch of range trading signals going on in the bond market. And we've got the oil markets, trading in and around $75 a barrel last 9-10 months. The truth is, basically everything, bonds, oil, stocks, are all range trading. And this is what the Fed actually desires. They want to take the economy sideways and slow the inflation rate down. So in many ways, the financial markets are already reflecting what the Fed wants.
Okay, against that background, strong buy stocks on your radar now include Ahold, I guess I pronounced that correctly, W.W. Grainger, and LVMH, Moet Hennessy, Louis Vuitton.
Right, so let's talk Ahold. This is a company that's in the Netherlands, actually. They have a big European grocer. I've got a price at about $33.50 a share, but it is a number one ranked stock because the earning estimates are going up. And they're going up pretty well, 4% this year, 5% next year. This is your inflation story. That food inflation is being, helping the grocers. So there you got to play in Europe for that trade. W.W. Grainger, amazing stock, $675 a share. You say that's overpriced. Well, guess what? It's making $33 a share this year, $36 a share next year. Price earnings ratio on the forward look is only 20, which is somewhat above the S&P 500, but not too much above. And of course, when you've got estimate revisions going up 7-8% a year like this is the number one ranked stock. You got to like it. I would personally wait for a big pullback in Grainger to buy it, but you got to like it for a short-term trade. LMVH, Moet Hennessy, Louis Vuitton. This is actually the guy who's the richest man in the world owns this company, or a good piece of it. A for growth and an A for momentum. Only a number 3 ranked stock now, but you've got $8 a share. Back in $178 in prices, and that's a PE at 25. Why does it get such a good high PE? Because for whatever reason, the luxury goods market, probably because it's broad and global and Asian and Arab and everywhere, is still quite strong, and this group is well positioned for that.
Okay, our chief equity strategist and economist, John Blank, summing up the markets in light of the recent banking turmoil. And with John, I'm Terry Ruffalo.
This material is being provided for informational purposes only, and nothing herein constitutes investment, legal, accounting, or tax advice, or a recommendation to buy, sell, or hold a security. Do not act or rely upon the information and advice given in this podcast without seeking the services of competent and professional legal, tax, or accounting counsel. Publication and distribution of this podcast is not intended to create, and the information contained herein does not constitute an attorney-client relationship. No recommendation or advice is being given as to whether any investment or strategy is suitable for a particular investor. It should not be assumed that any investments in securities, companies, sectors, or markets identified and described were or will be profitable. All information is current as of the date herein and is subject to change without notice. Any views or opinions expressed may not reflect those of Zacks Investment Research as a whole.